Hi, everyone. Welcome back to another edition of Lucia Capital Group Weekly. I'm Ray Lucia Jr., CEO of Lucia Capital Group, and I'm really excited to welcome back yet another member of our investment management team. And you all seen him before, Lance Helfert, Senior Vice President, Investment Professional, and, you know, the guy with the best hair I know. So, Lance, welcome back, brother.
Thank you. Thank you for having me.
I think your hair grew about an extra inch or so since the last time we shot one of these videos together. Looking good, my friend.
Thank you. Thank you.
So yeah, it's probably about a month ago. You know, we want to just catch up with you and just to see, you know, what your current thoughts are on the environment and the markets and the economy, because it's changed a lot since we last talked. So what do you see going on right now?
Yeah, the market's been very resilient. I think there's this kind of dichotomy between Wall Street and Main Street. You see, you know, places starting to open back up. And just speaking of my hair, I got an email yesterday from actually the place I've gotten my hair cut for years, and they've been around 22 years. They said they're not opening. So there's still lots of stuff to figure out on Main Street. And I think that, you know, Wall Street's really looking ahead. Big companies are doing really well. They're not having a problem with financing. And there's just this kind of, you know, struggle, I guess, between big, large cap companies and now some smaller retailers starting to do well. But it seems like the economy is ready to open and people are really looking to next year more than they are to this quarterly earnings. So the market's been doing really, really good.
Yeah. So, you know, when we say the market is doing really good, I think kind of what you're, you know, kind of hinting at is, you know, we're seeing more bankruptcies and a lot of stress in the economy, especially on the small business side, like your hair salon. And, you know, even though we're starting to see some dentists, you know, come back in the work and stuff like that. But still, I mean, when you go from, you know, the best and strongest economy, you know, we've had in our lifetime to zero revenue for a lot of these businesses, it's difficult for people to kind of equate, you know, hey, the market coming back from these, you know, really low lows to now, I mean, we're seeing some you know, economists projecting, you know, an all-time high this year. So, you know, if it was January 1, we were talking a little bit ago, you know, and we asked you, you know, someone said, hey, look, you know, we're going to see, you know, the worst numbers, you know, since the Great Depression, you know, 40 million people or so unemployed, and then the market kind of rebounding back. You know, it's hard for people to kind of equate the two. So, you know, how do people reconcile this?
Yeah, I think that it's really looking to the future, and every time a company announces their earnings, the analysts and asset managers don't really care as much about what happened last quarter. It's really about what they're looking to next quarter or next year and what they see is going to happen with their businesses. So I think that's really what's happening. I mean, we had such a severe, just dramatic drop for 6 weeks. Every day you wake up and it was limit down 7%, and you just once in a while you wake up and the market was down 2%. You were thrilled because it wasn't down 7%. But I think that now that people realize and experience that volatility, they're saying, okay, the world hasn't ended. The numbers for the virus really aren't what worst case or even base case were in the United States, and so I think that people really are looking to what's going to happen in the next year. And are we going to be back in 2021 where it was last year? Is it going to take us 6 months or 18 months? I mean, the market really is looking forward. And I think what they see is people getting lean again. You know, we had, like you said, we had a record economy in our generation, and people kind of, you know, they hire extra people, they spend more money, they maybe aren't in their business as much, but now they're tightening up again as far as, you know, really paying attention to their business and getting refocused on it. And so you see some companies at all-time highs. And like you said, there's been a couple of really well-known investors saying that by the end of the year, they expect us to be at record levels again, and partially, and you know, thanks to the Fed helping out, and they're buying assets, and you know, they're doing all they can to weather the storm, if you will.
Yeah. So, you know, I think also last time, you know, we talked about the book that you wrote a while back, and you know, one of the chapters in there is actually titled, you know, eyes believe what they see, but ears believe others, right? And you know, so you know, when you look at this stuff and people are trying to equate kind of the Main Street, you know, with Wall Street, and this divergence between what's actually really happening with people unemployed, but you know, stock markets potentially, you know, even hitting new highs later in the year, people talking about all of that. You know, I mean, what are some of the things that you think people could just look at, maybe down the road and then look back and say, if I really just, opened my eyes instead of just listening to others, that would have, I could have learned from that. So, I know there's a couple examples out there. What do you have to say to that?
Yeah, I think it's a perfect time for an individual investor that is out there saying, well, look, I know that the way I watch TV has changed. The way that I communicate has changed. The way that our children have communicated, from everything from, Facebook was popular for a while. My son Max was a senior in high school, and I always ask him to kind of get a gauge, what is it like? Is Facebook's kind of dying? Is it for an older generation? Is it coming back? And then, then it was Instagram, and then it was Snapchat, and now it's TikTok. And so if you don't really, use your eyes to see what's out there, you might look at the numbers for Facebook and say, oh, they're doing pretty good. Their earnings are good. The stock's doing really well. But when you talk to people that use it, or you use it yourself and you're using your own judgment, your own eyes, you'll see that Snapchat was popular and it's taking away from Facebook, which also owns Instagram. But then same thing now with TikTok. It's exploded. I mean, TikTok, they're on that TikTok way more now, especially I think because of the virus and the kids are home and people are home in general. So they're on that. I think that's one example. To look at the future and what it's going to look like, not look at what Facebook was 5 or 10 years ago. Another example is the liquor business, and spirits and beer and wine have been very, very resilient in recessions. You can look back at history and you'll see they've done very well during recession. So a couple months ago, I was talking to somebody and they told me they liked beer companies and spirit companies because it was recession resistant. And I thought to myself, all the restaurants are closed, all the bars are closed. That's a huge part of what they do. They're getting
the corporate Amex cards aren't being used, right?
It's free for them. That's right.
Travel's down.
Yeah, I thought, I don't know. I don't see that. I think that, sure, people buy their drinks at the grocery store and drink at home for their meals, if whatnot, but people are traveling less and people are not at bars at all. None of them were open for a long time. So I think that's a good example that, 2 or 3 years that we'll look back and say, gosh, that was obvious, but I was listening to everybody else. But I think the most important one really goes back to our philosophy, which is concentrated management. So Hertz just announced that they went bankrupt. There's been some unbelievable companies from, Neiman Marcus to, you name it, JCPenney, all these companies are going bankrupt. And if you're a passive investor and you're listening to what everyone tells you, that the market just goes up and you should just own an index fund and you'll do fine. People have this money in their 401k plans and they have to do those kind of things. But with your own money, with your advisor's recommendation, you can really take advantage of owning companies that are trading at good values, that are high quality businesses. And you don't have to own everything. You don't have to own expensive stocks and you don't have to own bad companies. And I think that's the most important lesson. And I think more and more people are continuing to talk about that. And we were talking earlier, the last 10 years, maybe 15 years have all been about passive management. No one can beat the market. Don't pick stocks, but that's slowly changing. It ebbs and flows in Wall Street. And I think for the next 10 years, you will see that big push toward active management and people that actually choose stocks and you don't have to own everything.
Yeah, I think I do. I think you're spot on. There's, when all the big brokerage firms went away with trading commissions, that basically made it an open game for individual investors to buy and sell individual stocks. You've got other platforms out there like Robinhood that gives access to, individual investors to pick their favorite companies instead of, what's been in the past, which were, no transaction fee mutual funds or exchange traded funds. So that was the quote unquote free way to get access to those types of companies through these fund vehicles. But the markets have changed quite a bit, and we see all in the financial press. It's about picking good companies and being smart about it. And I like your entrepreneurial investing philosophy and really believing what you see and not really listening to what everyone else is saying, because that's your own secret sauce, and it's worked for you over the years.
Yeah, and I mean, we wrote that book in 2006 or so, and it's the philosophy hasn't changed. It's just we keep plugging away, and like you said, it's been 20 years since we've been doing that. And a lot of times people might say like, oh, it seems risky to pick stocks and be concentrated. And I always tell them, I think it's more risky when you own 200 or 300 companies and you don't know what they do. You don't know what their balance sheet is. You really don't have the ability to understand what they do if you own that many stocks. Whereas we have 10 or 12. We know what day they're announcing earnings. We know what we're expecting. We've read the annual report. We know if they're making a change in their business. We know immediately if there's an acquisition, what that means to their margins and We know when we think that they're going to, we just bought a company recently, Kellogg. We think that they've increased their dividend in May or June for the last several years at a penny a share. They're doing great. And so I think they're going to do that again. We know what to expect from our companies because we have, 15 to manage and we know them well.
Yeah, I think it'll help people realize that when they buy a stock, they really do own a piece of that company, right? It's not just a way to gamble on whether other people will like that stock as well as they do, right? I mean, they actually are owners of that company, and you should know what you own. And so I love that about your approach is you know these companies, from the bottom up, how they work and their balance sheets and so forth, their cash flows. And, I think you're right. I think this is a pendulum kind of thing. So it swings all the way over to one side where it's all index, can't beat the market. And that's all in vogue. And now the pendulum's starting to swing. Well, wait a second. Maybe I shouldn't own just the market. Maybe I should own some individual stocks. And I think everyone should do a little bit of both, quite honestly. Right. My dad taught me this a long time ago, rather be 50% right than 100% wrong. Right. And so having a balance between some mutual funds or exchange traded funds, along with some individual stocks, kind of gives everybody diversification, but not overly diversified, and enough concentration, but not too concentrated. And, that's always been my philosophy as well. And which is why we have a variety of those types of strategies. So, Lance, any last thoughts you'd like to leave everybody with? Maybe talk about interest rates, or earnings in general, or even valuations, or the bucket strategy, or what would you like to leave everybody with today?
Yeah, I would say that there's a lot of talk now about inflation, and there was a lot of talk about gold and inflation after 2008 and 2009. Lots of talk about interest rates and how that is related to that. We've seen other countries, developed big countries that went negative on their interest rates, have negative interest rates. A lot of times there's speculation about deflation or inflation. I think that's what you really want to own and what you want to focus on is the long term. So if you have a strategy, a bucket strategy that says, I have bucket 3 and it's a long-term investment, I know I don't need that money tomorrow or next year or in 2 years, then stay the course and buy investments, or like we do, we buy stocks that we think we don't know what's going to happen with rates. We don't know what's going to happen with inflation. People were completely wrong when they thought gold was the investment of the trade of the lifetime after 2008 and 2009. Didn't turn out to be that way. So we position our portfolio so that if rates go up a lot or down a lot, if there's a Republican or a Democratic controlled political, environment, then we want companies that will be able to survive those and raise prices accordingly or manage expenses accordingly. So if you stay the course and you invest in long-term and you have a plan, a bucket plan, or any sort of strategy that's long-term focused like that, you don't have to worry if there's going to be inflation. You don't have to worry about the price of gold. You don't have to worry about deflation. It doesn't really matter.
And there it is, everybody. A money manager telling everybody you need to have a plan, right? You don't hear that too often on the television and that sort of thing. And it really is even money managers have their own philosophy. I call that their plan. And individual investors should have their own strategy. We use a bucket strategy here at Lucia Capital Group, and it's the bucket strategy that dictates how much you should have allocated into stocks. And when you own stocks, you should be thinking about having that bucket last for a very, very, very long time, and to let the folks like Lance and others manage the decisions of the day-to-day and to figure out how to benefit from all the changing winds in the markets. And so, Lance, I thank you so much for taking the time to talk with us today and to share your thoughts, and remind everybody that you are on the front lines of the markets and right there alongside with our financial advisors. And we love the fact that our financial advisors have access to you and the rest of your team. And so with all that, Lance, thank you so much. We're out of time, but everybody will be back again next week. And thanks again for watching, and we'll see you all again next time.